Hi, everybody, and welcome. Thank you for joining us on our WebEx Dirty Little Secrets. My name is Justin Carlson. I'm VP and Managing Director of Research here at East Daily Capital, and certainly happy to share some of my thoughts as well as our analyst team thoughts on the market in 2017. I've got with me Kendall Puig, who is the lead NGL researcher here at East Daily, and then Ryan Smith, who is our lead production analyst here at East Daily. And what we really want to do today is have a conversation about risk and have a conversation about what the market looks like in 2017 relative to that risk. And that really is what the dirty little secret is. What we're covering and what East Daily does, just as a way of a little intro on who we are and what we do, is we really define risk. And how we do that is by intersecting both what we know and love in commodity markets, and I've spent a lot of my career in commodity markets, and so have many of the analysts here, with what we know about financial markets and how those two intersect and how we dissect a company. And you can see by that Venn diagram in the middle how we dissect a company down at an asset level, figure out what the growth rates are, what the contracts look like, what the rate structures look like, forecast them from there, and then bring them up to a higher level so that we can reshape how the market uses data to quantify risks for these energy companies, and particularly midstream energy companies, but to a large extent also E&Ps. So before we get into risk, I want to note that there is a chat box in the bottom left-hand corner of your screen, and you can use that chat box to ask questions throughout the call. At the end of the call, we'll take your questions. Myself, Ryan, or Kendall, or any of the other analysts joining us today in the room might jump in and answer a few of your questions. And to the extent we don't get to your question, we're certainly happy to reply and let you know after the call, because we'd love to talk about this stuff. We love the energy markets, and it's really interesting to us. So let's just get into a little bit of detail about what I mean by breaking down and reshaping how we think about risk and how the market thinks about risk. I've used an example here in front of you of Energy Transfer. And Energy Transfer is interesting because it's a big company. It's got a lot of assets. And those assets, they break out for you in several segments. So interstate, intrastate, liquids, as well as the midstream segment. And you can see the midstream segment in that pie chart on the left makes up 31% of what they report. Now, this pie chart does exclude SXL and their investment in the retail sector, so I want to note that. But this is the other four segments. When you break down, and the degree of transparency is high, because this is on the segment level, that's exactly what ETP reports. But when you break down to the basin level and start to take that midstream segment and subdivide it, it becomes a lot more opaque. So understanding that Permian is 17% of that EBITDA, Ark-La-Tex is 9%, Marcellus is 22%, or the Eagle Ford is 31%. Further subdividing that risk by system, so King Ranch versus their Eagle Ford Super System, which is the majority of it. And then even from that Eagle Ford Super System, even providing additional transparency on which producers make up that Eagle Ford Super System. Now we can start getting into what's the counterparty risk? Who has issues? Who's growing? Where are they growing? How big are the wells? What do the decline rates look like? It's that kind of subdivision of risk that we want to understand where the market is going and how that shapes the company's performance in the year to come and in the years to come, quite frankly. I've consolidated that here into how we look at all risk. So we certainly break down companies, which you see across the top there, BWP, CEQP, DPM. We break down those companies, and then we look at their segments or what they report, but we also break down what they report or the segments they report in and the assets that they have by crude, natural gas, NGLs, as well as an other column. Let's just say, look at 17, and we'll just subdivide ETP again as our example. You could see in crude, $175 million in 2017 EBITDA, $3.2 billion in nat gas, and NGLs, $1.1 billion. So for a total of $4.5 billion. So that's how we break down crude, natural gas, and NGLs for them. And we can pull that all the way across for the 23 companies that we talk about in Dirty Little Secrets and see a total of almost $9 billion in 2017 for crude, 21 for nat gas, and 4.4 for NGLs. Now, what's interesting is when we look at 16 versus 17, we've got a growth total of about 7.1%. So 32 billion to 34.7 billion. 8.5% of that is crude, 6.9% natural gas, and 5.8% NGL. So a significant amount of that growth, or when we talk about from a percentage basis, is coming from the crude segment, although that 6.9 representing, let's call it roughly about $1.5 billion in nat gas growth is also fairly healthy and a fairly significant component of the sector growth. When we quantify and specifically break it down, so now let's subdivide that nat gas segment. Let's specifically look at gathering and processing. We can go horizontally across G&P and look at where companies have large G&P exposure versus companies that don't. So certainly when you look at it from a standpoint of, let's say, MEP or even ETP, significant G&P exposure, and all contributing to that 7.9% growth. But you can also look at it on a percentage of their company. So going back to that ETP example, ETP is 31% of their company's EBITDA, while from MEP's perspective, that total amount for 2017 actually represents 99%. So MEP significantly exposed to a G&P sector, which typically G&P is going to be a lot more volatile with commodity prices, typically doesn't have as many MVCs, although Ryan, as we get to talk to him, and Ryan, as we bring you in and have you talk about some of the G&P segment, does have MVCs on certain assets, and that's some of the dirty little secrets that come out when you start to subdivide these assets at a very granular level to see, how is EBITDA or how is revenue, gross margin fluctuating relative to the volumes in the asset itself. So some really interesting dynamics there, which Ryan might touch on a few, but which we fully explore in the paper in depth as we go into each company. When you break down G&P even further, and again, across to that 7.9%, you can see each company has different exposure levels from a sheer financial perspective to different basins. But in large, if you draw a swath across the Marcellus Permian, you can see all of those, and that number on the right is a percentage growth, 2016 versus 17. Permian is absolutely driving a lot of that growth on a percent basis, 71%, 26% for the Marcellus Northeast PA, and 11% for Marcellus Utica. And then you also get some help from Anadarko. Now, Anadarko, and Ryan will talk about tiers in a little bit, but from an Anadarko perspective, the Anadarko is growing, but the portion of it that's growing is the portion that we consider Tier 1 is going to be DeStack and Scoop, as opposed to the rest of the Anadarko, which is struggling more and quite frankly is pulling down the average for the basin as a whole. When you look at all the other basins within the sector, everything else is pulling down that 7.9% average. So the growth in all those, although still up in many basins, especially Tier 2s, which we've seen more recently a rebound at, and are still pulling it down. And the Barnett, for its part, is really pulling it down at negative 25.5%. Now, in the Barnett itself, and again, Ryan may hit on a few of these examples, and we touch on them extensively in the paper, but there are some companies who may have POP contracts or other financial structures where they may actually be up because it's more financial based than volume based, and they may have some caps there with MVCs that help bring in revenue. But nevertheless, as a whole, the basin is pulling down the average. Just to bring in ETP and kind of square this back up with what we talked about in the example that we've been using through the whole presentation. ETP itself is 31% is made up of G&P, again excluding SXL in the retail segment. 17% growth, 16 versus 17. A large majority of that's being driven by the Permian, and we'll talk about the Permian more during this discussion. But the Eagle Ford, even though the Eagle Ford as a whole is growing only marginally, ETP's Eagle Ford assets are doing fairly well, up 11%. And this is important because it makes up 9% of their entire the company's entire EBITDA. So it's a big portion of it and really relevant for what they're doing. Now, I'll hand it over to you, Ryan. Ryan, I'd like to just have you talk to everyone a little bit about how you subdivide, Tier 1, Tier 3, Tier 2, in fact, and then what you're seeing for the sector as a whole in 17, and then, especially beyond, too.
Well, thanks, Justin. Well, based on the previous slide, you can see that it's important to tell where your gathering and processing volumes are coming from. And we've segmented or bucketed different basins into a three-tier structure, with Tier 1 basins being the ones that they can weather a low-price environment. So names that come to mind are the Permian Basin, you mentioned the Scoop Stack, or the Marcellus. Those are some of the Tier 1 basins that can weather low-price environments and provide a lot of upside as well. As you can see in the oil graph, the Permian Basin is one of the few basins that has actually shown growth since 2015. So what we're showing here is cumulative growth on a percentage basis since January 2015. So the Permian Basin obviously has been able to weather the low-price oil environment. So even though oil prices dipped as much as 30% in the beginning of 2016, the Permian Basin continued to grow based on strong drilling activity. But as you see highlighted here later on, there are a few basins that have declined over the past couple of years, but we are seeing those declines start to reverse. And that's interesting because those basins, which we would consider a Tier 2 basin, are essentially reacting to a higher oil price now. So you can see here that you have the DJ Basin and even the Mid-Continent are starting to reverse some of those declines, and you're actually seeing slight production increases as you added rigs in some of those basins that we tend to consider more Tier 2. They tend to be more responsive to prices, whereas, like I mentioned earlier, Tier 1 is more insulated. They don't really respond as much to price. Moving on to the natural gas production chart you see here on the right, again, the Permian Basin's Tier 1, it's the blue line on the top. It's obviously grown in line with oil production. But one we pull in here is the Marcellus, and this is the Marcellus Utica combined, essentially. But you can see in 2015, you didn't see a lot of growth because you were pipeline constrained to the Marcellus. Once you added pipeline capacity in 2016, early 2016, late 2015, you saw you see a big bump in volumes that you've seen growth, but then you were capped out again. So we consider the Marcellus Tier 1, even though it doesn't have the huge growth of the Permian, it's still a Tier 1 basin because as we add new pipeline expansions later this year, 2017, you will start to see more growth coming out of the Marcellus. So since we've been talking about drilling activity, you can see here the map we put up. You can see all the rigs that are active as of about a week ago. And we've actually charted out, we've picked out a couple basins here where we can chart out the rig activity comparing May 2016 to December 2016. And the reason that we chose May is it's really the trough of drilling activity. You think about commodity prices that really crashed in the beginning of 2016, and producers were really feeling a lot of pain at that time, so they dropped their rigs. And then we saw a lot of rig adds at the back half of 2016 in response to higher commodity prices. So in the Marcellus, there were about 20 rigs operating in May, and we saw that increase to about 40 rigs by December 2016. So big response to commodity price increases there and to new capacity added in the basin. Moving up to the Bakken, we even saw a big rig add over 2016. We were below about 20 rigs again in May of 2016. And they added up 83% more rigs by December 2016 as operators responded to higher oil prices in the Bakken. We see similar responses in the Anadarko Basin, in the Eagle Ford, and then lastly the Permian as well. So I'll skip through these real quickly and really focus on the Anadarko and the Eagle Ford have really responded to higher oil prices. But when you look at the Permian, it's kind of it's a little bit different story because if you keep in mind the Permian was growing. Even with its May 2016 rig count, it was growing. So the rigs that we've added at the back half of 2016 and even early this year in 2017, you're just accelerating that growth that we're seeing out of the Permian. And so we're monitoring that on a pretty regular basis. So if we look at our forecasts for the Permian Basin and how they've changed over time, here's our second quarter 16 forecast for Permian Basin gas production. You still see growth. But then as you layer on higher oil prices, if I go to our third quarter forecast here, and then even our forecast here in first quarter 17, you see we have substantially more growth out of the Permian Basin because we've added more rigs, but we also have a higher forward price. And so part of the rig additions we're seeing are in response to that higher forward curve price, but also just to the fact that there's been new discoveries in the Permian Basin. You have technology shift. You have a lot of things changing. So that correlation that we see between rig adds in the Permian and oil price, you've seen it diverge a little bit because operators have been adding rigs so quickly that you have a pretty steep increase in gas and oil production coming up. And just to note that the number of horizontal wells that are being drilled today are the highest that we've seen in history. So you're drilling more horizontal wells now than you were back at peak oil prices in 2014. And that's very important, again, because you're not only reacting to the price of oil, you're reacting to new discoveries in the Permian Basin, new formations and new technologies being implemented there. So a big revival that we're seeing in the Permian Basin, and we expect a lot of growth out of there as well.
And Brian, I think we've also seen, and you can tell us, maybe the audience, some of these numbers, but IP rates are also higher too, correct?
That is correct, yes. We've seen a steep increase in IP rates. And we discussed those in the paper as well of the big increases that we've seen with the new formations being targeted. You are continuing to see new efficiencies added to drilling, including IP rates and lower drill times as well. But just to put the high level macro Permian forecast into perspective, here you can see we've chosen ETP's gathering system just to highlight some of the activity that we're seeing in the Permian Basin. So here is their ETP's gas gathering system, and then all of the processing plants in the basin, ETPs are colored orange here. And what we do is we allocate wells to these systems, and then we forecast each system going forward. So it's important to know which wells are feeding these gathering systems, because that determines which rigs are allocated to these systems as well. So ETP's gas gathering system is a great example of a system that's benefited from new rigs being added to the Permian Basin. So back in May, again, if we go back to kind of that trough in drilling activity in May of 2016, we estimate there were about 28 rigs operating on ETP's Permian system at that time. We've seen that grow to over 78 rigs today. So I just changed the map to show you January 22nd rig count, and there were 78 rigs operating on ETP system. So this is one system that has benefited a lot from the new rigs being added in the Permian Basin. They tend to expand their processing capacity to handle these new rigs, and we do expect significant growth on their system based on the rig allocation that we're seeing. And just to note, a lot of these rigs that have been added in the Permian were actually added in between the quarters. So if we look back at October, there was roughly about 40, 45 rigs operating at that time. And you think about October, that's back when the third quarter earnings calls were happening. So the Permian was emerging as a new storyline. But since those third quarter calls, we've actually added significantly more rigs. So again, we see over 75, 80 rigs operating on ETP systems today. So we actually monitor drilling activity on a monthly and weekly basis. This helps give us an indication of what's happening inter-quarter with some of these companies. So we would expect ETP to talk a lot about the Permian in its upcoming call based on the level of activity that we're estimating on their system. And just to take that, take all those things and put them into a financial impact by company. These are some of the companies that we pulled out of our paper that we actually highlight that have a high level of gathering and processing exposure to various basins. So the basins on the top are your tier ones like the Permian Basin, Marcellus, and Utica. These are the basins that we're seeing a lot of growth from. So companies like MPLX, ETP, they're going to benefit from activity in these basins. Tier 2s are actually growing as well, and that's because we've seen these commodity prices rebound at the back half of 2016. So Tier 2 basins don't look so bad, but keep in mind that if commodity prices take a downturn, these are going to be some of the first basins that you actually see activity drops in. So they're inherently a little bit more risky because they're commodity price sensitive, whereas we feel the Permian and Marcellus are more insulated from price activity. And then lastly, you have your Tier 3 basins that are generally declining, but like Justin mentioned earlier, you have some contract structure there that if you have some MVCs in place or you have some more percent of proceeds commodity exposure in those gathering and processing units, you're actually benefiting from higher commodity prices despite lower drilling activity or lower volumes. So Tier 3, it can be mixed depending on your contract structure, but generally we're seeing lower volumes, so even more risk in Tier 3 than Tier 2 basins.
All right, thanks, Ryan. Appreciate it. I'm sure there's a lot more to discuss there, but for the sake of brevity, we'll move on to natural gas pipelines and how G&P feeds into the natural gas system. So from a natural gas perspective, again, we'll look at that same sector breakout for natural gas, but instead focus on the interstate pipeline sector as well as the intrastate pipeline sector. You can see on the right 7% growth in 2017 for the interstate pipeline sector, and then about flat for the intrastate pipeline sector. When we look at it, across companies and see who has the heaviest exposure or who has the most percentage of their overall portfolio exposed to that, certainly the ones that come, to the top are the BWPs, Enable, ETP, various other ones, as well as 100% pipe companies like TCP. So moving on to natural gas pipes, and again, breaking out our ETP example, they have about $1.264 billion in 2017 that we expect to get from their interstate segment. So that exposure, that breakout can be subdivided into this, which is actually from some of our summary reports and in the paper itself, where we talk about the interstate sector, where $1.2 billion in the total segment. That can be subdivided into $771 million for the consolidated assets, $493 million in EBITDA for the unconsolidated assets, further subdivided between legacy and expansions. And you can see in the consolidated sector, $549 million in legacy and $222 million in expansions. But then let's even focus it down at an asset level and see that Panhandle, for its part, had about $126 million in 2016 EBITDA, but is expected to have $110 million in 2017 EBITDA. So the important factor here as we think about Panhandle, or maybe in a larger sense, think about ETP or any pipeline company, is that it's not just about their expansions, of which ETP has a significant amount of expansions, especially with Rover, but also about their legacy declines and legacy contract declines, rate pressure, volume pressure, understanding whose contract is that pipeline and where that exposure is. And so from Panhandle's standpoint, its legacy system is down 110. Now, this is not to negate the fact that they actually have an expansion, a backhaul expansion tied to Rover that's going to add about $40 million in EBITDA per year in 2017, or at least the second half of 2017 when it comes online. So that 110, when you look at Panhandle as a whole, they're actually going to be up year on year. But again, what's important to understand is that expansion for Panhandle is, I think, roughly around a 4x multiple. So it's a good multiple, but viewed in light of the attritional contracts, they needed a good multiple for that system. When you further take Panhandle, you can break it down by quarters. And then what we do in a lot of our reports, or in a lot of what we distribute on a financial blueprint for each one of these companies, is look at, on a quarterly basis, how much of their EBITDA is in each quarter, how does that lay out in both revenue and expenses, as well as who are the producers on their system, where are they levered to, what's the exposure to, because when you look at LDCs there at the bottom, which are about 1.8 BCF per day versus producers who are about 200 a day, there's a significantly different risk profile. Producers are generally going to be, and you're going to want to view them in a different light, as well as marketers or traders view them in a different light than you would view an LDC. So again, some important distinctions there as you start to subdivide a pipeline like Panhandle, or any pipeline for that matter. Contract cliffs. Now we talk about this extensively in the paper, and it's a big deal because when you look at contract cliffs, you've got the contract additions, or the new capacity additions by year, 2007, 8, 9 being the key ones there, where we've added a significant 40 BCF or over 40 BCF in 2008, 20 BCF in 2009, so on and so forth. So you've added a significant amount of expansion, which typically had 10 or 15-year contracts. So now let's transition down to the graph on the left, where you have 2017. These are contract expirations. So almost 40 BCF of contract expirations in 2017, about 26, 27 in 2018, about 21 in 2019, and then so on and so forth. Now, certainly, there's a large number of contracts that will extend of that 40 BCF coming up for expiration this year. There's a large number that will just roll. Utilities, LDCs, end users, industrials. A lot of them are likely to roll. Not all of them, but a lot of them are likely to roll into the following years. But when you break it down and start to look at what are those 10 and 15-year contracts that are at most risk to not be renewed, or at least have some rate pressure on them. So again, on the bottom there, you see contract expiration dates, And on the right-hand side in the legend, you see the contracts that started in 2007 that are going to be up for expiration along the bottom axis there. So the first example would be 2007 contracts. The 10 years, which expire in 2017, there's about 2 BCF. You've got less 18 through 21, but then in 22 you've got the 15-year contracts from 2007, originated in 2007, that's about 1 BCF up for expiration. For 2008 contracts in 18, there's about 4 BCF that are set to expire in 2018, those 10-year contracts, 2 BCF of 15-year contracts in 2023. In 19, you're almost at 6 of 10-year contracts, 2.5 of 15-year contracts. In 20, you're at 6 of 10-year contracts, about 1 of 15-year contracts. And you start to trail off as you get into the years where there were less expansions coming online. Now let's look at that as a percentage of total contract expiration. So the line that came across the top there is the percent of those bars relative to the graph on the left. So 15% of contracts are 10 and 15-year contracts that are set to expire in 2017. Go up to 2018, you've got about 30% of 10 and 15-year contracts set to expire. In 2019, you've got about 40%. In 2020, you've got about 46% of current contracts set to expire. Now, these numbers will certainly come down on a percentage basis as we roll contracts into the following years. But the point is, and maybe the magnitude is, that 6 BCF in 19 and that 6 BCF in 2020, those are significant because midstream management teams are looking at those now and trying to identify who's at risk and who is not at risk to renew either volume or rate, because both provide pressure on cash flow for these companies. And again, let's subdivide that into the producer, marketer, trader groups, where they represent about 10% in 17, 12% in 18, about 30% in 19, and then 35% in 2020. So a significant amount of contracts are tied to producers and marketers who, which we discussed before, are going to be a little more sensitive to either changes in production or changes in basis and how gas moves across the country, and obviously how basis prices influence how that gas moves. So what's really important there as we start to think about that is these are contracts that are at risk and really need to be looked at from that standpoint to understand what is the risk component, how does it offset with growth projects, and what are expectations going forward. One of the elements that's reshaping how the market thinks about and how the market will transpire, and certainly one of the big reasons why the market's changed so drastically from when those contracts were signed 10 to 15 years ago, is the fact that we've got the Marcellus, which has grown significantly from, oh man, when I started about 2 BCF to, when I started looking at the Northeast, about 2 BCF to where it is today at closer to 20 BCF or above 20 BCF. And the expectation that new expansion projects, particularly Sunrise, which was actually just approved over the weekend, Rover, and as well as Leidy and Leach and Gulf markets are going to start to change or allow more production to get out. Now let's go back all the way to what Ryan talked about with G&P and the fact that some of the G&P sector's growth, for instance, going again back to our example, ETP, is pinned to some of these projects and the fact that when they come online, they will allow more production to get out and thus allow the basin to grow, but also change the supply dynamics and start to push back on legacy contracts and where production used to come from, or where how supply used to be sourced by end users. So note we've got Nexus on here still. We still haven't seen a Nexus approval come through, or if it's coming through, it's coming through shortly. Maybe it already happened and we're waiting for a actual FERC filing to be posted. But Nexus is the one that's kind of out there. But even without Nexus, it's a significant amount of capacity and a significant amount of production that's reshaping, and again, you'll note the map there on the top, reshaping how all markets trade relative to it, because those Marcellus expansions are going in all different directions. the Gulf to Chicago to Ontario to the Northeast. So it's important and significant in how we think and how we understand legacy risk on pipelines. Just to highlight that, and note this is just 2016 versus 2017. So this does not talk about future risk of 18, 19 contract rolls, of which you saw a lot when I showed that graph 2 slides ago with respect to that 6 BCF that was rolling off in 19 and the 6 BCF of 10-year contracts rolling off in 2020. But just to look at 16 versus 17 and the difference between companies, BWP, for its part, actually has their legacy system expected to grow in 2016 versus 2017. Again, most of their expirations are going to come later beyond 2017 as Gulf Crossing starts to feel pressure. In particular, Gulf Crossing starts to feel pressure, whereas a company like SEP is also growing, about $18 million in 2016 versus 2017, versus an ETP, which we see and expect a decline of about $134 million in legacy contracts. Now, this is in part due to contract attrition or contracts rolling, but also due to contract negotiations, which you can see there on ETP with Tiger, the fact that they've had contract renegotiations. But again, this is something management teams are thinking about now, and we saw that with the BWP distribution cut back in 2014, where they looked out and saw that there was a significant amount of pressure on the natural gas markets and thus on contract renewals and contract rates in both their storage and their pipeline segment. But it also speaks to impairments by, on MEP by KMI and ETP, on Great Lakes by TCP. And again, I talked about contract renegotiations, TEP with REX. Now again, we've got to look at it as a whole, but these are all pieces that we need to understand respective of just dragging things forward and trying to understand contracts and contract renewals. We'll move on to the natural gas segment and talk about one of the biggest things that we're focusing on for the natural gas, or for the crude oil segment for 2017. It's certainly the Permian. And just to go back to that risk and understand risk on the crude oil from the crude oil market perspective, 8.5% growth 2016 versus 2017. You can see most of that is focused on that pipeline as well as gathering segment for crude oil at 10 and 13.2%. Less so on the other portions of crude oil storage, rail, trucking, as you might expect, are certainly not as up as much as the pipeline sector. And again, talking about natural gas, transitioning to oil, and thinking about how markets are being reshaped with all the expansions and now growth of places like the Permian, there's no doubt that the crude oil market is being reshaped. And then again, back to the percentage of those companies which are made up by crude oil. Some, as you might expect, are going to be the ones like MMP, which is 100% crude oil, whereas someone like ETP is certainly changing their dynamic, and you can see from an ETP perspective, 1,358% growth because they're entering the crude oil segment. And certainly, again, this is without SXL, so there's a significant difference there, and we'll be looking at a significantly different ETP in the future. But PAA, MMP, Magellan, both realizing, and you can see the growth down there at the bottom of the arrow, some significant growth at 9% and 23% for 2017. Back to talking about the Permian, takeaway from the Permian, certainly we and a lot of the markets focused on is there enough takeaway, and as the paper points out, there wasn't. And as we subsequently saw with Cactus expanding and BridgeTex expanding and then EPD expanding the Midland to Sealy line, they're rectifying that. And I'll take a look at that as a whole, but just to show what's included in our forecast, we include refinery demand, which is important to separate that refinery demand from some of the other pipelines that are noted, like Wink or Line 80, which feeds those refineries, and differentiate those as interbasin demand relative to the ones that have true takeaway to Houston or Corpus Christi or up into Oklahoma. As you can see there on the right, where we're looking more at Basin and Longhorn and BridgeTex and Cactus and some of the ones that we're certainly familiar with. So now if we transition to the Permian, we can see refinery demand come in. Longhorn. I'll build these out real quickly just so we can move through them. But as you see the expansions come online with BridgeTex and Cactus, it starts to add more capacity to the basin. But what's important here is now we look at that total capacity in the red line relative to, we adjusted this given the recent additions of Cactus as well as BridgeTex, but relative to 3 phases. That recovery phase where, again, Ryan pointed it out with rig counts on the gas side and on the gathering and processing side, but it's just as relevant on the crude oil side, where rig counts changed dramatically from Q3 or the end of Q3 into Q1 and where we are today. And that's added a significant amount of production to the curve, where now the Permian looks to grow about 600,000, maybe up to 700,000. Again, kind of depending, it's changing, quite frankly, a lot, but adding a lot of new production to the curve. So entry rate of entry and exit rate differentiated by about 600,000 barrels a day of oil, and that's justified or caused for call for new expansions. And you can clearly see that here. There was a significant pinch point at the end of 2017. And then again at the end of, or in 2018, as even after Midland to Sealy. So you quite frankly needed BridgeTex, you needed Cactus to expand, you needed Midland to Sealy to get bigger to boost up that red dotted line to above where production expectations are. Now there still might be a pinch point there right at the end of 2017 and 2018. Might see some basis fall out. It might actually call for some other projects to be built, and it wouldn't shock us if a few more come into play here. But from a standpoint of production growth, it's significant. Now, the one thing that we are watching very closely and cognizant of is we haven't allocated that orange area at the top or expect any more expansions at this point. And we're watching it very closely because, as you can imagine, you put 700,000 barrels a day of oil from the Permian, you add some from the DJ, recovered from the DJ, the Bakken's now starting to grow again. That's a lot of oil. And then when you consider world dynamics, is OPEC cheating on some of their volumes? I mean, we don't really know that. But what we do know is there's a lot of oil coming onto the market. We're back to a very healthy growth scenario, and it gives some pause to wonder, is that orange area out in the future true, or do we need maybe a slightly lower oil curve to slow down that growth in the Permian? Now we'll move on to NGLs, and from an NGL perspective, again, breaking it down and looking at total exposure to NGLs, 5.8% growth in 2017 versus 2016. You can certainly see the companies that are most exposed to that. When you look at 25% to ETP, 60% to OKS, 16% to SXE, Targa at 43%. And again, the big growth expectation that we're watching that we discussed in the paper is ethane and certainly supply growth, going all the way back to the Permian and how its growth has ripple effects across the industry. But that supply growth out of the Permian and the rebound and stability in some of the other basins are really important. But there's also some ethane recovery that we're going to be watching towards the back half of 17. And Kendall, if you wouldn't mind, I'd love if you talk a little bit about your expectations for 2017, what you're seeing, and what you think is relevant for the market to be looking at.
Sure. Thank you, Justin. So looking at a macro view of what's going on in the NGL market, starting with the supply side, we can see NGL production from gas plants, according to the EIA, for 2016 ranged between 3.3 and 3.6 million barrels a day. And we can see the breakout there of the different purity products according to the EIA. And I really want to point out that most of the variation that occurred in NGL production in 2016 was the result of changes in ethane rejection and recovery. So taking a look at just ethane, we can see a lot of noise in the back of the year, the second half of 2016, as we moved from rejection to recovery as frac spreads switched between being positive and being negative. So taking a look at C3+, the heavier end of the barrel, that's been remarkably steady. Propane production as a benchmark has really hovered around 1.15 million barrels a day, while ethane has really varied during this time period from about 1.15 to 1.4 million barrels a day. And we can also note here that the green area on the ethane production graph, that's PADD 3. And I think that there is a notion in the market sometimes that PADD 3 doesn't have a lot of rejection occurring in that area because it is already closest to market. But we have seen a lot of variation, about 150,000 barrel a day swings month over month in PADD 3. So that's showing us that there still is probably some upside to ethane recovery in the Gulf Coast area. Taking a high-level view of what we think is about ethane demand in 2017, it's no surprise that we see demand increases coming online. Taking a look at the orange bars, existing petrochemical demand for ethane has ranged between 900 and 1,100,000 barrels a day over the past 5 years. We do expect a big uptick going into the back half of 2017, and this could push into 2018 as well. But really what we're looking for to happen is a uptick in petrochemical demand from new facilities coming online, as well as a ramp up of export terminals. So we can see some brownfield expansions, as well as a small project from OxyChem, Mexichem, and then a ramp up of the Enterprise and Marcus Hook terminals, particularly the Enterprise terminal, going into 2017 and ramping up as those contracts come online and as some downstream infrastructure comes online. But really the big three world-scale projects, CBChem, Dow, ExxonMobil, those will really move the market. Those are about 86,000 barrels a day each of ethane demand coming online in the second half of 17, potentially some of them being delayed into the first quarter of 18, which is something we're constantly monitoring. And going into 2017, something I think the market's not talking about that might have some downside risk is that we are entering the year really with record high ethane storage levels. Storage levels as of November, about 55 million barrels. That's about 70% above the 5-year average. So this is something that could push some of those higher ethane prices and that ethane uplift further into 2018 as we start to work off some of the storage that is already in the ground right now. So that was kind of the 30,000-foot view of what we think of U.S. ethane demand going into 2017. Now looking at the recovery story, it's important to look at ethane recovery on a regional level, and really the transport cost to market from different areas is going to have a huge impact on which areas switch from ethane rejection to recovery. So this graph, or this map rather, shows some representative estimated transport costs for ethane from various basins to the Mont Belvieu demand market. You can see 8 cents from the Permian, 10 cents from the Anadarko, 23 cents on ATEX from the Marcellus Utica down to Mont Belvieu, and the highest cost barrel to get to market coming from the Bakken at about 29 cents a gallon in transport. So looking as we talk about the switch from rejection to recovery, we obviously expect areas closer to market, the Permian, the Eagle Ford, which isn't shown on here, but the cheapest to market, the Anadarko, to switch into recovery first. And then we really don't anticipate a time when Bakken recovery is economical for any significant period of time due to the high transport costs. And you also have to cover fractionation and get above your natural gas rejection floor. So in our view, Bakken recovery is really not going to be economic. You're more likely to see potentially at sustained high ethane prices, an expansion of ATEX, perhaps the Centennial pipeline conversion going through, getting more of that northeast ethane down to the Gulf, or at the ceiling having more cracking of propane or other feedstocks if ethane is really that expensive. So moving down to even a more granular view, we've seen that map a lot of transport costs from various basins, but what we haven't seen in the market before is a breakdown of really the upside for each individual company that owns assets in these basins. So this chart shows some of the key companies we cover with NGL, long-haul transportation, and fractionation assets, and trying to do an apples-to-apples comparison of what an incremental 10,000 barrels a day of ethane in various basins means for these companies. So one example is ONEOK. They commonly discuss their ethane upside, and they do have upside from the MidCon, from their Sterling pipeline systems, as well as from the Rockies, Overland Pass, and then again the Sterling and the Bakken. And we took a look at represented the tariff transport costs on all of these pipelines as well as the upside from their fractionation assets. We can see that ONEOK does have significant upside from the Mid-Con as well as the Rockies and the Bakken. But one nuance here is that the Rockies and the Bakken actually has the same upside because the Bakken pipeline has MVCs for the vast majority of the transport capacity. So there is upside for ONEOK from more ethane recovery as opposed to someone like Targa. Targa also does have ethane upside, but it's a smaller amount because they don't have those long-haul NGL pipelines that can move their volumes to Mont Belvieu. So all of Targa's ethane upside that we're showing here is from their fractionation assets. Another interesting example you can see here is Enterprise EPD out of the Northeast. They do have theoretical upside on the ATEX pipeline, but we've graded out here because we don't believe it's realistic that they will have that $35 million of upside. The ATEX pipeline is almost entirely contracted in 2017, and it's kind of an all-or-nothing situation for Enterprise out of the Northeast because they're receiving purity ethane into that pipeline, so they won't be able to capture any upside from fractionation of those volumes at Mont Belvieu.
Thanks, Kendall. And so let's jump into NGL exports. And I'll show this risk matrix again to talk about the exposure to NGL exports and what's happening. Again, 5.8% in total NGLs growth in 2016 versus 2017. When you look at export side of the business, the only company that we cover right now that has significant export exposure is going to be Targa. Certainly ETP has some exposure to exports, but they're 1%. It's insignificant relative to their overall systems or their overall assets. We are working on EPD and SXL and should have those done by the end of the quarter. So we'll have those broken down at an asset level, looking at each one of the assets and growth and decline curves and what that means for total exposure. But Kendall, maybe you can spend a little bit of time talking about Targa, but as well as referring to the rest of the companies in the context of what we know today about their facilities and the market in general.
Thanks, Justin. So taking a look at some LPG export trends over the past few years, this graph shows propane and butane exports versus LPG terminal capacity. And you can see that over the past few years it's been on a steady increase. There is a view in the market that every time we added new capacity in terms of export terminals, we filled that capacity pretty much right away. Now moving into 2016, we've seen some big expansions come online, particularly Enterprise in the fourth quarter of 2015, and we're finally moving into an unconstrained infrastructure situation where we have enough terminal capacity and we also have enough LPG shipping capacity that we're starting to see LPG volumes respond more to ebbs and flows in global demand. So highlighted here in third quarter of 2016, we saw the first quarter-over-quarter decrease in average LPG export volumes since first quarter of 2014. They've picked up in fourth quarter of 2016 again, but this is illustrating that we are seeing much more volatility in the market, and we can't expect to hit those terminal capacity constraints and hit those maximums every single quarter. Looking at where the LPG has been going, the graph on the left shows LPG exports by destination, and you can see in the orange bars that's the Asia Pacific market, and that has really been a driver of growth over the past few years. And taking a deeper dive into the individual countries in that Asian market, you can see the orange bars again are China, and they have really been driving a lot of growth from petrochemical demand, specifically PDH units coming online. So about 7 PDH units have come online in the country since 2013, and that's really been a huge, has really absorbed a lot of the U.S. volumes. But I think a risk here that's maybe not being discussed enough in the market is that it's risky to think of those PDH units as baseload demand. There's a lot of volatility there. Those units go offline and utilization rates vary a lot. And we actually saw LPG export volumes to China go from about 130,000 barrels a day in July to only about 20,000 barrels a day in August. So there's a lot of variation there and a lot of volatility. Looking at Europe, that has also been a large market for LPG, but the scale here is smaller than the Asian graph. But there is some risk here to the petrochemical aspect of this demand because this is going to feed some steam cracker switching, so it will be competing with naphtha for that demand source. Looking at LPG export capacity by country, and this kind of ties back to some of our company-specific risk that we were talking about with Targa and others, really looking into 2017, we need to take a deeper dive and see which companies have term contracts versus more available to the spot market, because that can really impact their earnings from these terminals. So taking Enterprise as an example, they have very publicly stated that about 100% of their LPG capacity is under term contract. This is important because they either receive the full terminal fee if the counterparty takes the LPG cargo, or a cancellation fee, which is often about 75% of the total terminal fee. If they do have a cancellation, they have the option of putting that cargo up on the spot market. And in Enterprise's situation, even if that spot cargo is not taken by a counterparty, they have the option of loading polymer-grade propylene to kind of offset those canceled slots. Looking at some of the other companies, Targa, who we noted has about 14% of total earnings coming from this terminal, has not disclosed many details about their contract mix in terms of term versus spot contracts. I don't think that zero of it is under term contracts, but it's definitely some more uncertainty there compared to some of the other terminal operators. Looking at Phillips 66, they have about 50% under term contracts, 25% they're marketing themselves and actually selling delivered cargoes, and 25% on the spot market. For Sunoco's Mariner South, the majority of it is contracted by Shell, and Mariner East, which is set to come online third quarter of 2017 with the Mariner East 2 pipeline, they have also not disclosed a contract mix in terms of the export volumes. So different risk profile here for each company, and something to keep in mind where, maybe when exports were rising across the board, kind of a rising tide lifts all boats, but now that exports have started to show more volatility, you might start to see some terminals fare much better than others.
Thanks, Kendall. Thanks, Ryan. We appreciate you guys filling in. And, of course, you've all been compiling questions at the bottom left-hand chat screen. So if you have any more, feel free to put them in now. We'll take a pause for just a brief second while we pull together our thoughts on some of those questions and start answering them. And again, as I said in the beginning, to the extent we don't get to your questions, we're certainly happy to follow up with you afterward. All right. Well, it looks like our first question is one that's relevant to today, and one that actually brings in someone that we didn't introduce or give any stage time in the call, Rob Wilson, who covers PAA for us and works a lot in the oil markets. But Rob, the first question is trying to get a better handle on PAA's marketing margin going forward. I can see that both MMP and SXL seem to be growing their marketing presence in the Permian. What does that mean for PAA?
Yeah, so Justin, that's a good question. I think from a volume perspective and Plains' Supply and Logistics segment, it's not going to have a big impact. The reason why I say that is because Plains has a lot of the underutilized capacity on their long-haul pipelines. So Plains will use Supply and Logistics defensively to get those volumes down their long-haul pipelines. For example, they have Cactus, which is about 60% utilized currently. They will, and they have scheduled to increase the capacity of Cactus by 60 a day in third quarter of 2017. They also have BridgeTex Pipeline, which is 300 a day, that is 50% owned with Magellan, and they're going to increase the capacity of that from 300 to 400 in the second quarter of 2017. So point being, Plains has a lot of unutilized capacity in their long-haul pipes, and they will use their marketing affiliate aggressively to get those volumes and ship them downstream. Now, from a profit per barrel perspective, having more market affiliates out there will put downward pressure on the margin. What I expect to offset that, or more than offset that, is growing production, as you pointed out earlier in this presentation, Justin, out of the Permian. And Plains' management talked about this morning, which is the production to MVC ratio. As that increases, as it's planned to, or as we have forecasted, as MVCs roll off towards the end of 17 and into 18, some of that competitive pressure should alleviate and offset the competition from SXL and Magellan.
Okay, perfect. Ryan, I think the next one is headed your way, which is, why is Eagle Ford production continuing to decline after rigs are up 86%?
Yeah, I think that's a good question. Actually, I meant to call that out in the slide, so I'm glad somebody asked that. But yeah, so as you can tell, Eagle Ford production has continued to decline over the last year, and we really haven't seen rigs being added to the Eagle Ford until the last month or so. So we actually saw a big jump in Eagle Ford production, or Eagle Ford rig counts, more recently, and we expect that to actually turn around our Eagle Ford production outlook in the next year. So we actually we're starting to offer basin level production estimates. So if you guys are interested in those, you know, we can do basin level production estimates based on rig counts and then the forward curve price. So currently our expectation for Eagle Ford production in 2017 is that it does move higher, as you've had a significant increase in rig counts. And I think of names like, you know, like Sanchez Energy. They've, with their acquisition of Anadarko's acreage, they actually plan to bring a bunch of drilled but uncompleted wells online this year too. So that will help support some Eagle Ford production, and you'll probably reverse those declines in 2017. So that's one of the basins that I think is a really good example of a tier 2 that you've seen this huge reaction to oil prices, and it's really put Eagle Ford back in the money in terms of drilling economics. So we do expect it to be up in 2017, so that's a good catch.
The next question, Kendall, actually falls into your court. How will the startup of Mariner East 2 impact the U.S. Gulf Coast LPG export terminals?
Thanks, Justin. That's a great question. I think one obvious consequence of this is that you'll have less volume of NGLs and LPG in particular moving from the Northeast down to the Gulf Coast by truck and rail, particularly rail. There are unit trains moving down right now from some of the fractionation in the Northeast down to the Gulf, so there will be less supply from those areas. But I think in terms of the terminals themselves, Mariner East 2 does have some distinct advantages over the Gulf Coast. They have a slightly lower transportation time to Europe, and they have the ability to offer some flexibility in terms of pricing. The Gulf Coast terminals are really, for the most part, offering Mont Belvieu plus a terminal fee, whereas at Marcus Hook they can offer some potentially ARA indexed or naphtha indexed contracts, which might be attractive to particularly traders who have been somewhat burned by the uptick or the collapse of the spread between Mont Belvieu and other markets. But on the downside for Mariner East, there's really not as much storage in the Marcus Hook area, so they have less flexibility to respond to fluctuations in demand. So I think it's kind of a mixed bag, but in general will create even more competition for the Gulf Coast terminals, which are already arguably overbuilt.
Okay. The next question is about EEP. Is EEP out of the woods yet? They've dropped their guidance 2 Fridays ago. DAPL getting approved, isn't that a good thing? I'll take that one, I guess. So from an EEP perspective, an EEP for its part, I think we had a guidance of about $1.8 billion in EBITDA. I don't think that's changed much for us. We've been optimistic about DAPL, so we haven't adjusted our guidance over the last several months for EEP. But I think from a DAPL perspective, we've always been concerned that when DAPL gets built, that there is some risk, or there is risk to contracts on their legacy systems that come out of the Eagle Ford. specifically their North Dakota pipeline and the fact that that does not have MVC. So when as DAPL comes online and starts to take more oil out of the area, then there is definitely risk we see to volumes that flow in the Dakota Access Pipeline. That actually also gets to another question that was asked about just contracts in general and who has the most risk towards contracts over the near term. And again, one of the ways to look at that is you can look at it from a sheer perspective of who has the most risk and certainly identify companies with a large amount of contracted capacity like an ETP or a KMI. But I think another way to also think about it is the importance or the significance of that risk. So a company like BWP may not have as much total risk, but as a percentage of their total portfolio, Gulf crossing contracts rolling off on Gulf South put a significant significant risk on the company itself. So certainly something we can discuss in depth, but as we look at all those, as we look at all the contracts, it varies based on the companies. We have run past our time here. We were certainly hoping to keep this to an hour, so we'll end it there. But I do want to encourage anybody to reach out to us. We're happy to take questions. We're happy to discuss. We will get back to some of the other questions that were asked on the call. We will contact you by email. And again, please contact us. And thanks for sharing the time with us. And we look forward to talking in the future.